Have you ever been in a position that was doing really great? You were up 100 pips and expected the market to continue for another 200 pips. So you waited and waited. After all, you're supposed to write your winners and cut your losses, right? Price retraces a little and you get a little uncomfortable. And you sit tight and start chanting the mantra, hold your winners, as if that would help. But no, the price retraces further and you watch as your paper profits vanish and your account is now in the red. Well, it turns out it wasn't a retracement, it was a reversal. That sucks, doesn't it? Unfortunately, this is a very common occurrence, so I felt the need to address this problem. So in this video, I'm going to show you when to take profits quickly and when you should be patient and take profits slowly. This isn't some indicator-based video where I show you a couple of indicators that can help you manage your trades. That's something that I've previously uploaded. It's actually something more profound because it goes deep into the psychology of the market participants. I will explain the underlying psychology behind why the market moves the way it moves and give you practical advice that you can start applying to your trading today. If that sounds good to you, then please hit that thumbs up button and subscribe to the channel if you are new. It helps support this channel so we can keep investing more money to improve the quality of our videos and serve you at the highest level possible. To encourage you to pay close attention as well, we also do a giveaway worth $37. If you wish to participate, then look for an emoji somewhere in this video. You can find the full instruction in the pinned comment down below as well. Now, for you to know when to take profit quickly and when you should throw your stop loss and take profit slowly, you have to understand the two kinds of price movements. And because there are no official names for this kind of price movements, and these are concepts I craft out of thin air, I'm gonna call it emotional trading and structured trading. This comes from my own trading experience, so you will not find this kind of information anywhere else on YouTube or Google. And that's another reason to smash the subscribe button if you have not already done so. Let me show you an example of how emotional trading looks and how structured trading looks before diving deeper into each. Right here, this is how emotional trading looks like. It's fast and the price doesn't take the time to consolidate. Think of it as a sprint. Price sprints from point A to point B. Now, contrast this with structured trading here. It's slower, price trends a little, takes time to consolidate, then resumes its trend. Think of it like a marathon runner who is pacing himself. Price is steady and pauses every now and then. The consolidation phase is where price builds up the pressure to trend further. It also functions as potential obstacles when the price starts reversing. So let's break down emotional trading and why it looks like this. Well, as the name suggests, emotional trading means that emotions fuel the movement. More specifically, greed and fear. Now, why does the price movement look like this? Well, that's because traders are fearful of missing out and hence jump onto the trade. This results in price moving really fast as traders are chasing after the market. You will often see big extended range candles that close near the top or bottom. When you spot emotional trading, this is the kind of scenario where you want to take your profits quickly. You can forget everything I say in this video, but not this portion, because it is the key to knowing when to take profits quickly or slowly. Have you heard of the saying, what comes easy won't last and what lasts won't come easy? Well, I don't mean to be philosophical here, but it's the same when it comes to trading. What goes up fast will come down fast. What goes down fast will come up fast. Whatever that isn't established over time won't last. A movement that hasn't had the time to consolidate and establish itself will not last. Hence, when you see emotional trading, it is time to take your profits quickly. Do not wait too long or use exit indicators to tell you when to exit. Often, if you wait for the indicators to give you the signal to exit, you would have already given back most of your paper profits. This is the kind of trading environment where you want to find the next key level and set in your take profit a couple of pips just before the level. This is not the kind of environment to sit tight on your winners and go for the big juicy reward to risk trades. Now, I'd like you to think about the underlying psychology behind this kind of movements. If emotional traders cause this movement, what do you think they will do when they see the price dropping? Well, being emotional traders, don't you reckon that they will start panicking and start liquidating their positions? Don't you think that they will quickly abandon their trades just as quickly as they did when they jump onto the trade without any form of planning? This is the underlying psychology behind what goes up fast will also come down fast. This is why you must lock in your profits quickly if you realize that you are in an emotional trading environment. Earlier on, I explained that there are two types of price movements: emotional trading and structured trading. You now understand emotional trading, so let's move on to structured trading. Right here is an example of structured trading. You can see that price trends, then consolidates a little, then starts to trend and then consolidates a little. This pattern repeats itself and you can see that the trend went on for quite some time. A structured trading pattern lasts for a longer time and you can see that it is made up of more candles than an emotional trading pattern. I like you to think about this from a psychological standpoint. What do you think is happening? Well, the trending portion tells us that the mass psychology of the market participants is tilted in one direction. In this case, it's bullish. It could be bearish as well, but let's go with this example. And because we have small consolidation or correction rather than a complete reversal of the entire move, it tells us that bulls are not taking profits and are still sitting tight with their positions. This has to be the case, otherwise the price would start reversing as the bulls liquidate their positions and start depressing the price down. When price resumes its trend, then we know for a fact that there is an established trend. The consolidation and correction are also where the big players are accumulating their positions for the next move. If price retraces back to the level, it is often well defended, and thus the trend is not easily broken. Remember the saying, what comes easy won't last and what lasts won't come easy? Well, establishing a trend like this isn't easy because the bulls and bears will fight it out at each consolidation level. And because it isn't easy, then structured trading is the opposite of emotional trading, which is what goes up slow will come down slow. What goes down slow will come up slow. Of course, I'm generalizing and it doesn't happen 100% of the time. Nothing works 100% of the time in trading. Try losing 100% of the time and you will find that you won't be able to do that even if you try. I'm trying to show you that you need to be patient with your winners if you find yourself in a structured trading environment. Do not be in a hurry to take profit. Instead, look to throw your stop loss and ride the trend. Now, if you are new to trading and don't know how to throw your stop loss or manage your trade, I recommend checking out the exit indicators trading videos that I've previously uploaded. That video will show you a couple of indicators to manage your trades so that you can maximize your profits. To be clear, you want to use all of those good stuff in a structured trading environment, not an emotional trading environment. As mentioned, by the time the indicator fires the exit signal, you would have already given back most of the profits in an emotional trading environment. So summing up this video, there are two kinds of price movements: emotional trading and structured trading. What goes up fast will also come down fast. What goes up slow will also come down slow. I also explained the underlying psychology behind why this is so. Remember that you want to take your profits quickly in an emotional trading environment, and in a structured trading environment, you want to be patient and ride your winners. That's it for this video. As promised, I will leave a link to the exit indicator trading video right here. Do check it out if you want to maximize your profit in a structured trading environment. Thanks for watching. Don't forget to subscribe, and I'll see you in the next video.